Best Buy just reported this morning, and from the looks of it, the stock is up, so people probably like the result. Let's check out exactly what they did. This is their actual press release from their website, which I highly recommend looking at when you go see what a company has done. So guys, they reported $10.6 billion in revenue versus $11.6 last year. But before you get all in a tizzy about this, just remember, this was coming off of last year's first quarter, was coming off the previous year's shutdown, a lot of pent-up demand. People were just getting back in, so I'm not as concerned about that. You look at an 8% drop in comparable sales versus a 37% increase. But again, 37% increase was coming from COVID. They had just been shut down. This is so naturally going to happen that way. All right, domestic comparable online sales percentage. Ouch, 15% drop. Okay. Now, this is probably, I personally like to buy off Best Buy online. I think it's easy. You can set it up for in-store pickup or they come out to your car. This is going to be how Best Buy competes with the world of Amazon, as well as having the expertise in the store to help you. Whenever I personally want to buy something electronic that's expensive, unless I know 100% about the product, I go to Best Buy. If it's an iPad, something similar, and unless I'm at Best Buy for something else, I'm going to buy it from Amazon or Apple.com because it's right there, it's easy. But whenever I need to learn about a product, I go to Best Buy. I think that's Best Buy's goal for the future as they go forward, is how can we differentiate ourselves from Amazon? All right, GAAP diluted earnings per share, 149 versus 232. All right, not great. And their GAAP operating income is percentage of revenue, 4.3 versus 6.6. Now, a couple other things I want to point out here. This is their guidance for the year. They're guiding now for between $48.3 and $50 billion. It is a little bit lower than they originally guided. So that's why I'm kind of surprised that Best Buy is up today, because their guidance came lower. Usually when guidance comes lower, the market likes to punish you. But for some reason, that's not the case here. Comparable sales decline of 3 to 6% versus previous outlook of 1 to 4%. This to me is the big, what the heck is going on here? Why are they up during the day today in such a tough market today? I mean, the NASDAQ right now is down over 3%. S&P is down 1.5%. So I don't understand that. But again, the market acts weird in different ways. Okay, guys, share purchases. Now, in Q1 of this year, the company returned a total of $654 million. Two different ways. One, $455 million in repurchases. The other is $199 million in dividends. Now, I like dividends and repurchases for a company like this. In an ideal world, they would stop the dividend and they just buy back shares. But I understand this isn't the real world. People like getting their dividends, so they're going to keep paying it out. But buying back these shares is great when a company is selling for such a low multiple. Let's pull up Best Buy on our Everything Money software. And guys, if you're one of our software subscribers, while you're watching this video, pull up Best Buy in your software, just log in and do it and follow along with me. So Best Buy had hit $142 per share and a low of 70 recently. It's now at 72. Oh, now it's actually down. So this is interesting. We just came down to do this video, and in that time, this company went from up almost 2% to now down today. So look at this PE, guys. The current PE is 7, and the 5-year PE is 10. If you've watched our videos, you realize how low that is. The other thing I like, this dividend yield of 4% is easy to cover. They did $2.5 billion in free cash flow last year. In the last 5 years, they've averaged 2.3. So they're spending about a little bit over a quarter of their money on dividends, which is easy to manage. And look at this 5-year return on invested capital, 30%. So these are all great things. I believe that Best Buy is an 8-pillar thriller. Yes, it is. Look at how many shares they've bought back, guys. They've bought back 24% of their shares. When companies are undervalued, buying back shares is awesome. It gives you a bigger and bigger piece of the pie. It drives up that earnings per share, which will eventually drive up the price of the company. So let's run Stock Analyzer right now, which is one of our tools to determine what we should pay for Best Buy. So we go to Stock Analyzer here. So one way to get an idea of where the revenue might go for a company is go to Analyst Estimates. You can get this on Google. We're going to have this as part of our software soon. So right here are the Analyst Estimates. For this year, analysts are expecting a drop of 3% compared to last year, but they are expecting growth from there on out. Guys, this is a big company with a lot of online competition. They need to get into the online space more and more and more to stay relevant. So as you can see, their revenue growth is projected to not be that great. So my goal in the stock analyzer tool is to sit there and figure out a conservative number for revenue growth going forward, because every investment's the present value of all future cash flow. Let's look at their earnings per share estimates for the next few years. Even though revenue growth isn't big, look at the earnings per share growth. How's that happening? That's happening because of share buybacks. If you cut the number of shares in half, it makes the profit double per share. That's the whole idea behind buying back cheap shares. So let's go input these estimates right now. Someone just sent me a message on our chat. All right, so I'm going to be conservative. I'm going to say it's 0%, 2%, and 4% revenue growth. All right, profit margin. Now I look at these 10 years, numbers 2.5, and last year was 4.7. It's probably somewhere in this range, because I know in the early part of this decade they were losing money. So I'm going to call it 2.75, 3.25, and 3.75% profit margin. Free cash flow, I'm going to say 3.25, 3.75, and 4.25. PE, 10, 12, and 14. It's still retail, so I still want to be conservative. And I want a 12.5% return on my money for my ample margin of safety versus the market of 9 or 10% in an ETF. I hit the analyze button. All right, guys. So this is telling me right here that based on the low range of 50 to 60, a high range of 106 to 120, and a mid-range around 75 to 85. And that's assuming all these mid-range numbers happen. So in our software, if you're following along, if you like this and you want a notification when it hits some number, let's say 61, you hit plus, add to your watch list and notify me, boom, it's in your system. And there you go. So for Best Buy, it might be an opportunity right now. Go do more research and go figure out if you want to buy the company.